are thrilled to be here.
We're delighted to have you.
Thank you. You earlier today discussed intrinsic value, and I'm a big fan of Graham and Fisher, especially security analysis. What differences do you have, if any, for calculating intrinsic value versus what was said in security analysis? And for example, how does management factor into that? You recently mentioned evaluating management is like dating. And recently, you said also management does matter. My second part is, which company do you fear the most? Why is it that no one else has done what you have done? I mean, Coca-Cola has their Pepsi. Thank you.
Yeah, actually, Graham didn't get too specific about intrinsic value in terms of precise calculations. But intrinsic value has come to be equated with, and I think quite properly, with what you might call private business value. Now, I'm not sure who was the first one that came up with it, but, well, the first one that came up with it was Aesop, actually. But the intrinsic value of any business, if you could foresee the future perfectly, is the present value of all cash that will be ever distributed for that business between now and Judgment Day. And we're not perfect at estimating that, obviously. But that's what an investment or a business is all about. You put money in and you take money out. Aesop said a bird in the hand is worth two in the bush. Now, he said that around 600 BC or something like that. But that hasn't been improved on very much by the business professors now. Now, the question is, how sure are you that there are two in the bush? How far away is the bush? There are all kinds of things. What are interest rates? But, I mean, Aesop wanted to leave us something to play with over the next couple thousand years, so he didn't spell the whole thing out. But that's what intrinsic value essentially is. We don't. Graham would say that. Phil Fisher would say that. Phil Fisher would say that in calculating that, he would want to look a lot harder at the qualitative factors of the business in making that estimate of how many birds were in the bush. Graham would say he would want to see the bush, $2 worth of cash in the bush, and to pay $1 for it now. And one emphasized quantitative factors and one emphasized qualitative factors, but neither one would have disagreed with the math. And I started out very influenced by Graham, so I emphasized quantitative factors. Charlie came along and said I was all wrong, and that he'd learned more in law than I'd learned in financial studies and everything, and that I should think more about qualitative factors, and he was right. And Phil Fisher said the same thing. But that's what intrinsic value is about. If you buy a McDonald's franchise, if you buy General Motors, whatever it may be, the real question is, A, are you going to have to put more cash into it after you buy it? But it's really cash in, cash out, when, what discount rate, all the standard stuff. In terms of if I had a silver bullet, what company would I shoot as being a threat to us? I don't see any competitor to Berkshire. I see private equity buying lots of businesses and having an advantage in that they'll leverage up when we won't, and also that presently they can borrow money very cheap and all of that. So, I mean, there are always going to be people competing with us to buy businesses, which is our main occupation for me and Charlie. But I don't see anybody that's got a model or trying to build a model that will essentially go after what we're trying to achieve, which is to buy wonderful businesses from people that care about where their business goes and who generally want to keep on running them. Charlie?
Well, as I've said earlier, I think the Berkshire model, as now constructed, will have what they said in show business was legs. It will go a long time. and I think it will be quite creditable. And I think it has enough advantage that it will just keep going a long time. And I think most big businesses don't. If you stop to think about it, all the great big businesses of yesteryear, how few of them have really gotten big and stayed big. Of the really old businesses, only one stayed big, and that was Rockefeller's Standard Oil. And so we're getting up into a territory where very few people keep going well. But I think we'll be more like Standard Oil than we'll be like ordinary businesses, because I think we will just keep going. We will keep doing what we're already doing, and we'll keep learning from our mistakes. And the people up here are no longer all that important. The momentum's in place, the ethos is in place. It's going to keep going. And if you young people in the audience, I always say, don't be too quick to sell the stock.
Why don't we get more copycats?
It reminds me of our mutual friend Ed Davis. He figured out to do an operation that was so difficult that he operated at the bottom of a dark hole with instruments of his own creation. He gave his own shots by Novocaine, 87 of them, while he was operating. And it was a better operation. His death rate was 2%, and everybody else was 20%. And the other surgeons came to copy him. And they watched him. And I just said, well, I don't think I'll try and copy that. I think it looks just too hard to do. There's nothing in an American business school that teaches people to be like Berkshire.
Eddie Davis is the guy that, in effect, introduced the two of us. He was a famous urologist here in Omaha, and
but people didn't try and learn his operation. And it doesn't look all that easy. It's very different.
it's slow too.
And it's slow. It's very slow.
I think the slowness deters more people than anything else.
And the difficulty with being slow is you're dead before it's finished.
Well, that's kind of cheerful. Carol, let's come up with something a little.
For a more cheerful subject, mine is inflation.
Only compared to Charlie can inflation be cheerful.
This comes from Larry Pitkowski and Keith Trauner at the Good Haven Fund. In your 1981 shareholder letter, you discuss returns on equity, interest rates, and inflation, and how difficult it was for many companies to function under inflationary conditions. Indeed, that Berkshire itself was not immune and could be negatively affected. Today, it seems like every central banker in the world is desperate to create inflation, something that is generally great for debtors, not so great for creditors, and difficult for owners and managers. Should investors and business owners be thinking more about inflation and higher interest rates after 30 years of declines in both? How would Berkshire behave differently if it became apparent that the future was turning inflationary?
Well, inflation would hurt us, but it would hurt most businesses. It doesn't. There's certain assets that, if highly leveraged, obviously would benefit from inflation. But well, we'll set up an inflationary condition. Let's just assume tonight that drones are set up over all of the United States, and they happen to drop $1 million in every household. Now, the question is, would the country be better off? Every individual would now have or every family would now have $1 million that they didn't have the day before. The one thing I can guarantee you is that Berkshire would be worse off at that point, obviously. Obviously what I've described would be wildly inflationary. The trick in that circumstances is to find out that you've got $1 million before anybody else finds out that they have, and you'll do very well if you're first. But essentially, you don't create wealth by inflation or by you can move it around, but you don't create it by inflation, and you don't a firm like Berkshire, our earnings per share would go up. The intrinsic value of our business measured in dollars would go up. But under lots of inflation, unless we'd leverage those businesses, the value of your investment in real terms would go down. Charlie?
Well, we had a test of hyperinflation in Weimar, Germany, and the people who owned stocks in places like Berkshire got through, and they didn't prosper joyously, but they got through. And everybody else, practically, life insurance policies, bank deposits, you name it, got wiped out. And of course, if you create so much misery that you get a Hitler and a World War and a Holocaust and so forth, it's not a good thing to let things go that far. And so I don't like this huge confidence that all you have to do is just keep printing money and spending it. I think there's some limit to when that will work, and I am never going to forget Weimar, Germany. And I don't think any of the rest of us should either. We can handle a little bit of subpar growth for some stretch or other, but it would be quite dangerous to let the whole damn thing blow up because a bunch of crazy politicians were printing money.
If you own a home, though, with a very large mortgage and you have incredible inflation, it wipes out the mortgage, and you've still got the home. I mean,
in Weimar, Germany, they gave you the mortgage back at the end. Well, it's very interesting. That's the one thing they did right.
He's way ahead of me, folks.